How do you? Are you
I'm gonna.
Okay, thank you so much. Okay. Yeah. I'll just start. Once you do.
Who you value? What company you valuing? Interesting. Okay, folks. Time is here, so I'm going to get started. Couple of things. One is, if you haven't picked a company, for God's sakes, the time is here. Now, even if it means opening up the, online, pick a random company. First company you read about, just pick it and just do it. I mean, otherwise I don't trust you to pick. You got some psychological barrier, so just pick. If you've picked a company already and you haven't opened the spreadsheet I sent you, open the spreadsheet. If you've opened the spreadsheet and you've done nothing, start entering the numbers for your company. If your company has not quite reported the 2023 numbers, start going with trailing 12-month numbers. You can go back and update the numbers. To get your valuations done, I'm saying the obvious, you got to get started. And if you wait till you feel absolutely confident, you will be waiting till the very last moment because you'll never feel confident. You need a first draft. And I'll tell you what, you're going to go looking for information. But when you go looking for information, you're going to find yourself drowning in too much, right? Do a Google search of your company or the business it's in. You're going to get thousands and thousands of hits, right? And if you go down the Google page, you're going to go very quickly into dark places where you won't come out of. The advantage of doing the spreadsheet first is you can start asking about which inputs you feel most uncertain about, and that'll then drive your search. It'll allow you to be focused in your information search. That's what I'm looking for. I'm feeling uncertain about growth. I'm going to go collect as much information I can about the market. You want to focus your information search around those inputs almost. That'll force you. In fact, when I first valued Tesla, I used to keep folders on my Mac where I had a growth folder, a profitability folder, a reinvestment folder. And every time I read a news story about Tesla, I would put in one of those three folders. So I'd see a news story where the California Supreme Court has just decided that Tesla has to treat its drivers as employees. If you remember, that was, so which of those three folders would you put that in? That the California Supreme Court has found that Tesla has to treat its drivers as employees. What does that mean? Yeah. So tell me how it plays out. Where would you show it? So I can see it's bad news, but what is it impacting? Is it affecting growth? Is it affecting margins? Is it affecting reinvestment? And tell me why. What is it about treating your drivers as employees that's going to raise your costs? Well, you might, but even if you don't pay, you pay them the same amount. They keep 20%. You have to pay Social Security tax. So there's basically an added component. Now, if you get sued, you can't hide behind their independent contractors. We're not, you are the company behind them. So I'll put in the cost folder. Not that I'm going to do something about it right now, but I'm going to come back to it when I frame the story about margins, and I'm going to look at that story and say, you know what, I have to be a little more cautious about margins because this is going to happen across the country. Eventually, these drivers are going to be treated as employees. That's going to have cost consequences. So as you read stories, then you can put it into folders that you can then use to craft your story about the company. So today's class, we're going to talk about what I call the loose ends in valuation. And one of those things that we're going to talk about is something we take as a slam dunk. You value a company. It's got a big cash balance. Cash and marketable securities. It's right there on the balance sheet, $1 billion. Okay. So let's assume you look at that cash balance. For the case of Google, it's $110 billion. So it's not penny change, it's a lot of cash. And you see an equity research analyst write about that cash balance, and he says that cash balance is a bad investment. And here's his rationale. You know how much, income or interest income Google is probably making on that cash balance? Can you guess? What's cash marketable securities usually invested in, especially when it's 110 billion? Not mutual funds. You can't invest in stocks. It's got to be liquid and close to risk. it's actually, you're going to bypass mutual fund. 110 billion, you can drown a fund and you get all kinds of, you're just going to directly buy T-bills and commercial paper. And right now, what rate would you earn if you put your money in T-bills and commercial paper? About 5%. So that $110 billion is invested at 5%. You know what the return on invested cap for Google is as a company? It's about 30%. So here's my rationale. Tell me what I'm missing here. I'm the analyst. I'm saying cash is a bad investment because it makes only 5%. Google's making 30%. So they should either return the cash or invest it in the rest of the business. What is it? It's completely logical. What am I missing when I say that? It's liquidity. Okay. So it's more liquid investment. So I should settle for less. But is there a much more tangible test I can run for why 5% is not a bad rate of return to earn? This morning I invested, I swept the cash in my, which I didn't do 5 years ago, I wouldn't even, but every week I get in, I sweep the cash in my online brokerage account directly into T-bills. You can actually bid on a T-bill auction. Anybody can do it, so you can go in. So I took the cash. Why? Because it's sitting as cash, it's earning nothing. This morning when I invested in T-bills, guess what I was able to get as a rate of return? About 5%. That's a test run. If I took my money and invested in something liquid and riskless today, what would I make? If it's 5%, then earning 5% on the 110 billion in cash makes it a zero net present value investment. It's not good, it's not bad, but it's definitely not a bad investment. In fact, I'd rather Google keep the money in cash than put more money in Gemini. Because given how much cash seems to be going down that hole and nothing coming out. So cash is not a bad investment. So we're going to talk about when is cash a bad investment, but it's not a bad investment. It's invested in T-bills and commercial paper, and that's all you're doing. So let's try a second alternative. Today, we're also going to talk about what I call the black hole evaluation, where you really get lost. Some of you have companies which have shares in other companies. They're called cross holdings. Okay? So let's assume company A owns 60% of company B. You're valuing company A, it owns 60% of company B. And you're looking at the financial statements of this company. How much of company B are you going to, so let's say you start with the income statement. What are you going to see? And what, but not by law, by accounting rules, right? There's not a law, but there is an accounting rule. It's called consolidation. I've never understood this, but if you own more than 50%, you're required to consolidate. What does that mean? When you do your revenues, you have to count 100% of the revenues. When you do your expenses, you have to count 100% of the expenses. When you show your balance sheet, you have to, and at each stage you say, but I own only 60%. The accountant says, don't worry, don't worry. Don't worry. And then last moment he wakes up and says, you own only 60%. I said, that's what I've been trying to tell you all this time. You don't own 40%. Duh. So what does the accountant do to reflect the 40% that you don't own? Non-controlling interest, which side of the balance sheet will you see it on? Give it a shot, 50-50. Assets, try again. It'll show up on the liabilities right under equity because the accountant overcounted. You own only 60%. So we're going to talk about the consequence, because when you value these companies, what do we start to get to? Operating income. When you use operating income, what have you done? You valued 100% of the subsidiary. You got some cleaning up to do when you're all done, because you don't own 40% of that company. Now, if you own 10% of another company, something entirely different happens. It's called a minority holding. Then how does the accounting work? So when you look at the income statement, you look at revenues, you look at operating income, how much of that holding will show up? Anybody want to try? What do you think? None of it in revenues, none of it in operating income. If you keep going below the operating income line, somewhere after net income, there'll be this adjustment, or before net, there'll be an adjustment of the 10% of the net income from that company. Already you can see that understanding accounting for cross holdings is going to be critical in what you do, because otherwise you'll be double counting things, miscounting things, missing entire holdings altogether. So we're going to talk about cross holdings. One final example. Let's say you've done a discounted cash flow valuation of a company. Let's say it's JP Morgan. You value the company. And then you look at the balance sheet and some of these notes. So, but let's go down a list of items. So the question you're asking is, I've done a DCF valuation. Should I be adding this to my DCF value? What about the headquarters building for this company? If you have a headquarters building in New York City, it could be worth $1 billion. Should I add the value of that headquarters building to my discounted cash flow valuation? What do you think? Tell me why not. It actually is adding value. Who's in that headquarters building for JP Morgan? 277 Park? Traders and bankers, right? What are they doing? They look like they're busy all the time. But that income and cash flow you get as JP Morgan comes from those people in the building. Once you count the income and the cash flows, the people working in the building, you can't also count the building. That's double counting. You own a hotel. You can take the revenues you make as a hotel, but for God's sakes, don't add the value of the real estate the hotel sits on, because then you're having your cake and eating it too. You don't seem convinced. Oh, okay. Okay, good. So basically, that's a good question. That's a question of control. You can ask it about any asset. You're saying, what if I could get out of 277 Park and move to, what is that, Long Island City, where Citigroup moved all its people and nobody wanted to work anymore because they were lost in the Netherlands? You could talk about it. Or to New Jersey. No, you're going to Hoboken from this day on and you're living in New York City. So what the heck did I buy into? So we'll talk about what happens, but you can't, if you do that, then you got to tell me where you're going to move and we can talk about the difference in that. What about vacant land? Is there vacant land left in New York? I think I walked by one in the East Village. Looked like a lot of drug dealers were on that land. So let's say you own that land. Could I add the value of that land? And what's the question you had to ask before you added the land? Exactly. Or do you plan to use it? If in your cash flows, you'd built in the expectation that you would develop that land and you built in your cash flows, then you can't count it. But if you haven't, then you should count. You see where I'm going, right? You cannot count something that's already in your cash flows, but you should be able to count things that haven't. Let's keep going. What about patents? You're a pharmaceutical company. Patents are clearly valuable. When I value a Merck and a Pfizer, should I add the value of the patents to my discounted cash flow valuation? Tell me why again. Exactly. Now, by now, I think you're getting the same. It's already in the cash flows. And again, we can ask the question, is this the best use for the patent? Maybe if I sold it to Upjohn, they could do better. But you can't have a discounted. What about brand name for a consumer product company? What? It's already in there. I'll tell you, one of my favorite ads of all time was an ad for ragu spaghetti sauce. It's a long time ago. You can find it on Google. So here's how the ad works, or at least it looked on TV. There's this 45-year-old Italian gentleman who's wandering into his mother's house for dinner. Big time loser, obviously, because obviously he comes to his mother's house for dinner repeatedly. So he walks in the kitchen. His mom is stirring spaghetti sauce on the stove and she's surrounded by empty bottles of ragu. And he says, Mom, what are you doing? She said, I'm making spaghetti sauce. She said, from a bottle? To which her response should be, if you don't keep showing up every night for dinner, I would make it from scratch, but you show up every night. And then he starts listing out ingredients. Forgive me if I get the wrong ingredient. I'm not that good at spaghetti sauce. So let me start with the obvious ones. Where's the tomato? Guess what it is? It's in there. Where's the oregano? It's in there. Where's the cayenne? I'm Indian. I throw cayenne into everything, but it's in there. The answer in a good valuation, it should be in there. If it's not in there, then I should be adding it on, but I can't be adding something that generates cash flows. Here's an easy one. What about goodwill? What is goodwill? It's not an asset. It's a plug variable, right? I might as well just call it X. What about X? Well, I'm not, unless you're Twitter, in which case X is your name. You're not adding X on, right? So basically good. What if your CEO has been buying Picassos, using company money and hung it all over the headquarters building? First, you should get a new CEO. But technically, these Picassos belong to the shareholders, right? You know how companies, I mean, many large companies have these penthouse apartments on Fifth Avenue overlooking Central Park West. Technically, as a shareholder in the company, don't do anything stupid of showing up in the building, say, I'm a shareholder in the company. Can I stay in the penthouse for 2 days? That's not going to go well, but it is. Now, do you see why there's a lot of mopping up to do after DCF? And the older the company, the more mopping up to do. So we're going to talk about all of those things, but let me first go back and finish the last section of intrinsic valuation. So we talked about cash flows, we talked about growth rates, we talked about terminal value. Let's bring this to closure. Let's say your job was to build your own spreadsheet to value an individual company. I've taken that role for myself, but let's say you wanted to do it. Let's talk about the process of how you'd go about building it. So basically, you have to pick a cash flow, it's a very generic level, you have to pick a discount rate, and have to pick some kind of growth pattern. How quickly is your growth going to change? Every discounted cash flow valuation, you're going to see those three ingredients. So let's look at the choices you face when you sit down to value a company. Here's your first choice. Do you want to do an equity valuation or a firm valuation? Remember, we gave you two choices. You can take cash flows to equity, discounted the cost of equity, or take pre-debt cash flows, discounted the cost of capital. What do we say if you do it right will happen? They should give you the same value. See, why does it matter? I'm a lazy person. So when I'm looking at the two choices, you know which one I pick. Whichever one is going to be less work for me to do. So let's look at the two choices. To do an equity valuation, what do I need? I need free cash flows to equity, right? So help me out with the ingredients. What goes into free cash flow to equity? You start with net income. Then you subtract out reinvestment. Then you add debt issuances. You subtract debt payments to come up with free cash flow to equity. So when you change debt ratios in a free cash flow to equity, you have to show it as debt repayments, debt issuances. When you change debt ratio in a firm valuation, where does it show up? Because clearly it's a pre-debt cash flow. It's not showing up there. Where is changing your debt? If it doesn't show up in the cash flows, it has to, what do we discount free cash flow of the firm at? And what goes into cost of capital, or cost of equity, cost of debt, and the weights, the two and the beta based on the weights, right? So if I plan to change the debt ratio in a free cash flow of the firm, I change it through the cost of capital. I don't know about you, but I'd rather change the cost of capital than mess with the cash flows, especially as you go through time. So here's the simple answer. If your company has changing leverage, you expect the debt ratio to go up or down over time, it's much better to do a firm valuation because it's less work. Not because it gives you more accurate value, but because it'll be less work. Okay. Remember in the first weekly challenge, I asked you to come up with an equity value and how when you had growth, how much of a pain it was to compute the free cash flow equity. I know if you didn't look at it, you have no idea what I'm talking about. But if you go back, it's a pain in the neck to get free cash flows equity when the leverage changes. So here's the first fork in the road. If you're in a firm where leverage is stable, then you can use the shortcut for free cash flow equity. You multiply by 1 minus the debt ratio. But in every other case, free cash flow to the firm is going to win out, which means 9 times out of 10, if you have to pick, very uncertain about leverage, do a firm valuation. It's easier to do it right than with an equity valuation. So that's the first fork in the road, firm valuation or equity valuation. But let's say you pick the equity valuation route, you come to a second fork in the road. Do I discount dividends or do we discount free cash flow equity, which is less work? Dividends, you can just see it, right? So if you're lazy, you're saying, I'll do dividends. And it'll work as long as the dividends are roughly equal to the free cash flow equity. But if not, you can value the company easily, but you're going to get a very misleading sense of value. So if you can compute free cash flow equity, it's a no-brainer. Do a free cash flow equity valuation. Why trust something that might or might not be equal to the free cash flow equity? But here's the one place where dividend discount models so over the last 60 or 70 years, dividend discount models have become rarer and rarer because as long as you can compute free cash flows, the argument is, why would I go to dividends? But to use a free cash flow equity model, you need to be able to compute free cash flow equity, right? So let me list out the items. You need net income, you need net capex, you need change in working capital, you need debt issuances, debt repayments, right? 5 items. Let's suppose I gave you JP Morgan to value. Let's start at the top. Can you get the net income for JP Morgan? Yeah, it's right there at the bottom line. What's net capex for a bank? What's change in working capital for a bank? It could be everything, it could be nothing. What's debt issuance and debt repayment for an institution where debt is raw material? With banks for the last few decades, as long as people have tried to estimate free cash flow to equity and very quickly given up. And when you give up, where do you end up? Desperation drives you to dividends. And for the much of the last 7 or 8 decades, that's how we valued banks. It's not because we came to a fork in the road, but basically this is the only thing we have that we can. Until 2008, I used to value banks almost entirely with dividend discount models. But when you use a dividend discount model, what are you implicitly assuming? That you can trust banks to pay out what they can afford to in dividends. I'll make a confession. I don't trust banks. You don't trust banks, you can't do a dividend discount model. So I'll talk about a way in which you might be able to get free cash flows equity for a bank. Because it is extremely dangerous to take the dividends and discount them and hope and pray that they're paying out what they can afford. You had a question? It will get you a different value. Why? Let's isolate why. What they can afford. So it gives you a different value because the dividends are different from the free cash flow equity. It doesn't have to, right? If companies paid out what they could afford to, you can argue the dividend. So it's not that the models are bad. It's that there is an underlying assumption you're making with models that it's not holding up. Remember, most people are not valuing it. What are they doing? They're pricing it. You live in a world of pricing and you want to be a value person. It's not a question of are they, for all you know, they have never used a discounted cash flow model in their lives. They're buying JP Morgan because it's got a great CEO. They're buying JP Morgan because its price to book ratio still looks good to them. So we live in a world where people are pricing things. So you can't assume that the rest of the world is using a model because all you observe is the price, demand and supply, right? Everybody's pricing it, but we're valuing it, right? That's the faith part. You're saying, why would the price ever adjust to my value? Maybe it won't. Maybe it won't. So in a sense, you have to decide what your essence, what value you're having faith in, and then you got to assume the market will come around to your point of view. And saying, what if it doesn't? That's why it's faith. It's not guaranteed, right? That's the basis for intrinsic valuation. So dividends of free cash flow equity, if you can compute free cash flow equity, use free cash flow equity. If you cannot, you've tried, then use the dividend discount model. Now, if you think about what discount rate to use, it gets chosen for you, right? If you use dividends of free cash flow equity, your discount rate has to be the cost of equity. If you use pre-debt cash flows, it'll be cost of capital. There's really no choice. What currency should you do the valuation in? What's the answer to that? If you do it right, you should get the same answer. Just be consistent. You decide to value it in Turkish lira, you're going to have a high discount rate, high growth rates. If you decide to do it in euros, you'll get a much lower growth rate for the same company. Just be consistent. Should you do it in real or nominal terms? Do we live in a real world or a nominal world? Now, I went into this Mamoun's falafel, right? I ordered my usual, which usually cost me $3 4 years ago. It's now costing like $6. I offered to pay in real terms. I said, I don't like this nominal world. It's just getting out of control. The guy is very rude. He said, take it or leave it. I'm not giving you $3. We live in a nominal world. I'm going to do my taxes in a few days. I'd love to tell the IRS my income is not as high as it seems. The 6% inflation really put a dent on it. Can I discount my income and report a real income? I'd love to be able to get away with it, but I'd probably end up in serious trouble if I did. We live in a world where things happen in nominal terms. And and I think it makes sense to stay with nominal numbers, unless you have really high inflation rates. I mean, I just saw that Turkey reported that its inflation rate in the most recent month was 67%. You know what happens if you have a 67% inflation rate in your Excel spreadsheet? your columns have to start to get wider and wider as you go further out in time, because you're going to start to add zeros and double zeros. Your number will become 10. I mean, it's a reality that when inflation gets really high, you try to avoid it. You can go to another currency, you can do things in real terms. Nominal or real, I'll leave the choice to you, but I think nominal is more realistic. And if you can pick a nominal and stay with it, no, you should be okay. Finally, you picked a cash flow, you picked a discount rate. Let's talk about what growth pattern should I give my company. Let's say you're valuing Philip Morris. How many years of growth do you think is left in Philip Morris? It was since 1990, this company's basically had fixed or negative growth. Why? Because fewer and fewer people smoke. So what kind of model? You can assume the company is a stable, a mature company now, and you're done. You're valuing Volkswagen. Again, where's the growth going to come from? We talked about electric cars, brief moment of hope a year ago, and now that's been kind of taken away. Mature company in a mature business. Your company can be valued already with just one stable growth model. You know how convenient this is? To value a company, you need only 3 numbers. What's the expected cash flow next year? What's the cost of capital? What's the growth rate? You're done. I know some of you are already thinking, maybe I should change companies. I should do Con Ed. You can value Con Ed with a stable growth model. There's no growth here. It's you can, so mature company are already there. If you have a firm that is already large and growing, but there is a part of the company that can potentially grow. I'll give you an example. I valued Levi Strauss when it went public in 2019. Mature company, pretty much, right? I have all the jeans I need and they don't wear out. So it's not like I'm going to keep replacing them. This is the opposite of fast fashion. It's really, really, really slow fashion. But there's one part of the world where they don't sell as much as they could, which is Asia. And either Asians don't like to wear jeans as much as the rest of the world, but if you could get every Indian farmer into Levi's, think about how many more Levi's you could sell. That might never happen. But when valuing Levi Strauss, you might say, look, there's one part of the world which is a big market that they've gone into. You might give them growth, but it's going to be muted, right? It's going to be a period. You're going to maybe grow at 10% rather than 4%, and then it's going to go away. That's a classic 2-stage model where you have 8-10% growth for the next 5 years, and then you drop off to stable growth. There's a third scenario, and this is the most general scenario. You have a company that's growth rate is high. It could be changing. It could be, this is a 3-stage, 4-stage model where essentially you have growth and then the growth starts to level off. It doesn't drop off dramatically to stable growth. That's the most generic model. Stable growth, 2-stage, 3-stage. I gave you only one spreadsheet, right? You know that spreadsheet is malleable enough to fit all 3 models. If you have a mature company and you have my simple Ginzu spreadsheet, even though it has a 10-year growth period, here's all you need to do to make it a stable growth model. Make your growth rate for the next 10 years equal to your growth rate in perpetuity, 3% forever. Keep your margin stable and your sales to capital ratio equal to the current sales to capital ratio. The model will very quickly adapt and become a stable growth model. You want to make it a 2-stage model? Not a problem. For the first 5 years, I'll let you set a growth rate, a revenue growth rate. You can set it at 10%. But after year 5, if you set the revenue growth rate to the growth rate in perpetuity, it'll become a 2-stage model. At the end of year 5, you drop to stable growth. So the reason I did that is I used to have 3 different models, and then people would be confused. They would start on one model and then they'd change their mind. They'd have to move everything to a different one. This model allows you to make your company, whatever model you want to make it, it's malleable enough to do it. So here's the bottom line. When you think about a company that is, that is a mature company already, you can use a stable growth model. If it's a company with some growth, you can use a 2-stage model. But those are just words. Basically, it's a reflection of how quickly do you get down to stable growth and when will it happen? Yes. Well, basically, the growth rate of the economy is the economy's growth rate. So right now, it's what 3-4% is the growth rate of the economy. Think about the risk-free rate. So you have 11-12% growth. You can get away with the 2-stage model. If you have 60% growth, you should probably have some kind of a transition period before you get it down to 4%. It's just purely a common sense argument. So the reason I do this is often I get at least one person calling me every week saying, I've discovered a new discounted cash flow model. And I just let them go on because I'm curious, what exactly have you discovered that's never been done before? And the answer is almost never something new. It's like, heard the old saying of pouring old wine into new bottles. I'll give you an example. You've heard of Sanford Bernstein, well-regarded investment manager. About, I think 30 years ago, they patented a two-stage dividend discount model. If you think about it, what's new about it? Is it the two stages? Is it the dividends? Is it the discount? Is it the model? The answer is absolutely nothing. It was just a traditional model. Because ultimately, DCF, if you think about it, is just collecting three ingredients. So think of these as three Lego boxes. Remember when you used to play with Lego or Duplo when you were a kid? There's the cash flow Duplo box, there's a discount rate Duplo box, and there's a growth pattern. You put the three pieces together, you got a discount. You can create an infinite number of combinations, but they're all cash flow, discount rate, growth rate combinations. So next time you see a discounted cash flow model that somebody has provided, start by asking, what kind of model is it? Is it an equity model or a firm model? In the process, you might find the model itself is inconsistent. They're discounting cash flows to equity, the cost of capital, but that's a good place to start diagnosing models. Any questions about the mechanics of intrinsic valuation? So where are we now? You've taken cash flows, you come up with the cost of capital, you've discounted the cash flows, you come up with the present value. Heave a sigh of relief, right? You think you're done. And this is when the real mischief begins. Let me explain. You know how academia works? I work incredibly hard. I have to teach like 4.5 hours a week for 30 weeks of the year. I do get 20-something weeks off, but it's 30 weeks, 4.5 hours a week. I'm so exhausted that every 7th year they give me that year off with pay. It's called a sabbatical. Don't let any professor tell you this is a tough life. We live a cushy life. And so the sabbatical, it's very biblical. You work 6 years, you get the 7th year off. So 2006, I have my sabbatical year. And usually people have big plans for the sabbatical year. They're going to write a book and papers and research. You know what my plan for my sabbatical year was? I wanted to wake up every day for 365 days with nothing to do. And I actually decided to make this explicit. I went to Staples and I got this to-do board that you could put on the wall. I brought it home. I planned to stay home all 365 days. I had this little cubicle in my house. This is when I lived in New Jersey, right? And right above the cubicle, I put the to-do with nothing on it. At that time, all 4 of my kids were at home, still in school. So they came down the stairs to go to school, and I pointed to my to-do list and, look, kids have nothing to do today. Pissed them off no end. They got to their car, they went off. And then I made my fatal mistake. My wife came down the stairs and, "Hon, I have nothing to do today." She said, "Really? Why don't you take the dog for a walk?" I took the dog for a walk. I come back, there are 3 things on my to-do list. I said, "What happened here?" My plans destroyed right on day 1. It says, "Pick up bok choy at the grocery store." I'll make a confession. I didn't even know what bok choy looked like. I was too embarrassed to ask. I look at the meat section. There's no bok. Finally, I find it's this ugly looking cabbage. I come back an hour and a half later. Just pick up kids at school. So after the second or third item, I need to find things to do to keep my wife off my list. I'm desperate. So I check my email. And there's an email from the CFA magazine. I didn't even know there's a magazine called the CFA magazine. And the editor of the magazine said, "Would you write an article for us?" My normal reaction would be, "I'm on sabbatical. I want nothing to do." But then I remembered I needed things to do. So I said, yes. So I write in big letters on my to-do list. Write article for CFA magazine, cannot pick up bok choy kids, et cetera, et cetera, et cetera. So I sit down and write the article. And I have to tell you, this is the only thing I've written in my life that's got me hate mail. You know how difficult it is to get hate mail in valuation? Nobody feels strongly as, "I hate you for using bottom-up betas." And nobody feels that intensely about betas. But this got me hate mail from appraisers, partly because of the title of the article. It said, "Stop the Garnishing." And I was talking about the process of people completing a valuation of a company, then adding 20% for control, knocking off 35% for liquidity, adding 30% for this. I said, if you do this, you're going to end up where you wanted to be before you even thought about valuing the company. It undercuts the entire point. So I get a wave of hate mail. And whenever I start to get a wave of hate mail, I create a smart mailbox where if those words appear, it just goes in, I don't have to read it. But one must have slipped through the cracks here, shows up in my regular email, says it's from an appraiser who says, if you don't like what we're doing in valuation, why don't you come up with a better way of doing it? You know, that's right, that's a good point. So I said, you're right. I have 11 months left on my sabbatical. And here's what I'm going to do. Every month, I'm going to pick up a garnish and talk about it. So the first month was about control. So you guys talk about control, you add 20%. What is the true value of control? Next month was liquidity. Third month was cash. The fourth month was, it's become one. So it first defeated my entire objective for my sabbatical, which is to do nothing. It's now one half of one of my books, the second half of The Modern and Valuation, which is the first book I wrote. It's those loose ends. So I'm going to take you on a speedy run through those loose ends. I'm going to start with cash. Conventional wisdom in cash is don't mess with it. Got 100 million cash, add the 100 million. I'm going to ask you a question. Are there some companies where you might discount the cash of that company? Are there other companies who might attach a premium to cash? Then I'm going to talk about cross holdings. In a perfect world, how would you value cross holdings? In the world you and I live in, how are we going to value cross holdings? Because the information might not be there. You're working with scanty information on what the cross holdings are. Then I want to talk about other assets. We talk about vacant land. What are the kinds of things you'd be adding to a DCF valuation without double counting? And along the way, we'll talk about what if my assets are underutilized. That headquarters building could be sold off and I could move to a different building. How do I bring that into? Once I get to value the firm, I'm going to talk about should we punish some firms for making life difficult for us? You know what I'm talking about, right? Some of you are working with companies and they're incredibly frustrating. It's clear that their objective is to not inform you, but to confuse you. Should you punish this company for being complex or complicated? Should we reward companies that are simple? You might think the answer is obvious, but it's not that easy to bring in. I also want to talk about, what debt should we subtract out to get to value of equity? There are a couple of issues I'll hold off to acquisitions on synergy and control, but a lot of items on my agenda. So let's start with the first of those items. Oh, along the way, I also want to talk about stock-based compensation. As you know, many companies have shifted to using restricted stock or options to reward managers and employees. How does that affect your value and my value of equity in this company? So let's start with the value of cash. Should be the simplest of all assets to value, right? It's there. They say it's 100 million. And the way we deal with it is we usually add it to our value of operating assets, present value of the free cash for the firm at the cost of capital. We add the cash on. Somebody remind me again, why do we add the cash on? Ask the same question we asked about other assets. Is it already in my cash flows? Why not? No, but how do we get our cash flows? What do we start with as a measure of earnings for free cash for the firm? We didn't start with net income. We start with operating income for free cash to the firm. Operating income is before interest income from cash. The reason we add cash back is the same reason we added the value of the vacant land back. It's not been counted yet. So basically, when you do an equity valuation, it becomes messier because when you start with net income, the interest income from cash is part of the net income. God help you, because you have no idea what you value the cash at. It goes into this free cash at equity and gets discounted. To be honest, we don't think seriously about cash. We assume it's counted, but we don't know whether it's counted right. So let's talk about when cash is neutral. In other words, it's worth exactly what it is. When it's discounted. So I'm going to give you 3 companies. Okay? I'm very creative. I've called the companies company A, B, and C. That's one of my creative days. Each of these companies looks exactly the same enterprise value. So think of that as the present value of the cash flows at the cost of capital, $1 billion. All 3 companies have $100 million in cash. It's actually there, so there's no fraud there. But here's where the companies deviate. The first company has historically earned a return on capital of about 10%. Its cost of capital is 10%. The second company has historically earned a return on capital of 5%. Its cost of capital is 10%. And the third company has historically earned a return on capital of 22%. The cost of capital is 12%. The first two companies are US companies. The third company is an Argentine company. So here's my question. I'm going to argue that in one of these three companies, cash is going to be a neutral asset. You know what I mean by neutral asset? 100 million in cash is worth roughly 100 million. In one of these three companies, I'm going to argue you're going to discount the cash in the hands of the company. And if you pick that company, I'd like you to tell me why you're discounting the cash. And in one of these companies, you might actually attach a premium to the cash. Let's start with the easy one. Which of these three companies is cash most likely to be a neutral asset? What is it? Which company? Because of their history, right? We don't know what the return, what is their history? They take zero net present value projects. They don't, I call these blah companies. What do blah companies do? They don't add value. They don't destroy value. They just run in place. In a company like that, you add the cash on because you say, look, even if they invested the cash, they take zero net present value investments. Which of these three companies are you going to discount the cash? C, I hear a C. What is it about C that's good? But they've found a way. They've built it in the cost of capital. They're earning a 22% return. So their cash is being invested in marketable securities. So they're earning a fair rate of return on that cash, just like Google did. Well, you could say that. So, but that doesn't make them make the cash less valuable. It could be even more valuable, right? If they invested it. But by itself, the cash doesn't hurt you. You're saying the cash could be deployed at the 22%. It'd make them even more valuable. But it shouldn't reduce the value of the cash. You could argue that might actually attach a premium to the cash. They have good investments. If they find a way to invest that cash, it'll make them even more valuable. What is it about company B that scares you? The history. What's a history? It's a history of stupidity. We're attaching a stupidity discount. We're saying these managers are so stupid that if I leave $100 million in their hand, they'll find a way to screw it up. There are some companies where you look at the manager and say, I wouldn't trust these guys with $10, let alone $100 million, because they have a history of doing wasteful things. Like what? Big acquisitions. They overpay. They take projects. They put their money into AI, even though they have no idea what they're doing. Okay? You don't discount cash because it's earning 5% in T-bills. You discount cash because the management of this company can take the cash and invest it in really bad projects. You see, does this happen in the real world? What's Carl Icahn's big strength? Is he a deep thinker, you think? Here's what a Carl Icahn pitch looks like. You have too much cash, give me the cash. That's basically goes to company. You have too much cash, give me the cash. Paid out as dividends. But do you know what his strength has historically been? He targets the right companies. Because if you take company B, why is the cash being discounted? Because I don't trust you with the cash, right? What's the best way to get rid of the discount? Give the cash back. That's what activist investors do with companies with bad track records and lots of cash. They say, you've got to give the cash back. A couple of weeks ago, I took the Mag 7 stocks. They all have big cash balances. Apple is the largest still, 163 billion. And Google is the second largest, 110 billion. Historically, Google's been cut a lot of slack. Why? Great company. Amazing returns. Do you think those days might be coming to an end? What is it about? What is it that Google has done? Well, essentially, it's like a one-hit wonder. You know what one-hit wonders are? Somebody who sings a song, and I couldn't even think of it, but it's a great hit, amazing, top song, and they never have another, forget about a hit, another song the rest of their lives. Google's been a one-hit wonder. What's a hit? The search box. Everything else they've done since, maybe YouTube as an acquisition, everything else has been just cashed down the drain. Remember 8 years ago, they renamed themselves Alphabet? Why did they do it? Because they wanted to tell the world, look, we're not just a search box. We have these 6 other businesses. That's the bets. This should be Snow White and the 7 Dwarfs, not alphabets, right? Because basically you have the search engine as Snow White and you got the 7 bets as the dwarfs, but it's sucking up cash, and the dwarfs actually were cash cows rather than cash drains, but think of the bets as. And I think this Gemini thing, it might be a small thing. It kind of builds on that doubt. Can Google ever get a hit together? And that seed of doubt is what makes people say, maybe we shouldn't leave 110 billion in cash. Who knows what they can screw it up on? I wouldn't be surprised if Google is the next company where an activist investor pops up and challenges the company. And given where Google is now, that might require at least a change in management or at least some reaction but there's hope, right? Facebook faced a very similar set of circumstances 2 years ago. Remember after that $110 billion or $100 billion metaverse fiasco, Facebook stock, because people had lost faith. They were actually discounting Facebook's cash balance, which is 60 billion, as if it was worth nothing. That's how bad it had got. They said, Mark Zuckerberg can't chew gum and walk at the same time. He will ruin the $60 billion. I thought it was an overreaction. That's why I bought Facebook then, because I said, you can have issues with Mark Zuckerberg, but his whole money is tied up in the company. He's not going to be that stupid. I could have been completely wrong. But cash can get discounted in the wrong hands because you don't trust the management. So should you discount cash in the hands of your company? Having a large cash balance by itself is not a problem. But if you have a large cash balance and your track record starts to reflect the fact that people don't trust you, it can get discounted. And it can get discounted, it's not because it's earning a low rate of return. In fact, that's the safest place. If Google could guarantee that they'd leave the cash balance in T-bills for the rest of eternity, it's a strange thing to say. Their value might be higher than what it is if people worry about what will you do with the cash. So remind me again, why do we discount cash in some companies and not in others? Sounds like we're being unfair. Because you earn the right to hold on to cash, right? If you're a good company, you deliver a great track record, you could build large cash balance. There's a reason people let Apple have cash balances of 200, 250, 300 billion dollars. Its biggest cash balance was 267 billion, I think 7 years ago. That's enough money to buy Greece. I mean, that $267 billion in one company. And nobody raised a whisper about it. For 2 reasons. One is you look at the Apple's track record. At that time, it was the largest market cap company. And second, who runs Apple? A guy called Tim Cook. Is he a pretty disciplined person? How many big acquisitions has Apple done? The answer is none. You have disciplined management and you trust the management, you can build up large cash balances, not in perpetuity until you lose the trust. Now, to just see if this actually happens in practice, I'm going to call on a study that I thought was the most fascinating. I'm not fascinated by academic papers that much, but this one is actually because it asks a very interesting question. It asks, how much is $1 in cash valued in the hands of a typical company? So they took all US companies, very clever way of isolating the cash from the rest of the assets and say, here's what they found overall. $1 in cash is valued at roughly $1. You're saying you needed a paper to tell me this? But academics often write papers to deliver the obvious. So, but in this case, they asked an interesting follow-up question. That was across all companies. When they picked mature companies with negative excess returns, what does that mean, negative excess returns? Their return on capital is less than the cost of capital. Companies like Company B, $1 in cash was valued at 69 cents. Think about that. You have 10 billion in cash. You have a bad track record. Investors act like you have only 6.9 billion. But I did not complete the last story because company A had neutral, company B was a discount. Company C, there might be a potential discount. Let's talk about why. In traditional corporate finance, you don't need a cash balance. No company does. You know why? Because if you have a great project, what do we assume you can do? Go raise capital. Capital markets are always open and accessible. They will give you money. There's no transactions cost, no issuance cost. You raise it. So who needs a cash balance? If you flip it on its head, the reason we hold cash is because there are frictions in the market. You might not be able to raise that capital quickly, so you keep the cash balance. Now, do you see why I put company C in Argentina? Just remember, the last 20 years, Argentina has had at least 5 events where the entire capital markets have shut down. You can't raise equity, you can't borrow money. If you live in a world where capital markets can shut down, is there a value to having a big cash balance? Of course. It'll allow you to survive the next crisis. And even more critically, you will now have the scarcest resource in a crisis, which is cash on hand, which you can use to buy other companies' assets for a fraction of the value. If you're a company with limited access to capital or operating in a market where it does make sense for you to hold a cash balance, and that cash balance might actually make you a more valuable company, you might attach a premium. And this study actually found that they focused on small, high growth firms. $1 in cash was valued at about $1.20. So if you see a young, small tech company with a lot of potential with a big cash balance, think of it as a good thing that'll allow them to survive, to deliver the promise that comes from the growth that you see in this company. So that's a cash. Let me talk about something very closely related to this cash balance question. You know how a mutual fund works, right? A Fidelity, Magellan. Most mutual funds are called open-end mutual funds. Somebody help me with the mechanics of what happens. Let's say you have $10,000 to invest in a T. Rowe Price fund. You send the $10,000 to T. Rowe Price. It goes into the fund. What happens? It's invested in stocks. The number of units in the fund increases to reflect it. And in an open-end fund, the net asset value basically is whatever the value of the stocks is. That's how most mutual funds are set up, as open-end funds. But there's a subset of mutual funds that are called closed-end mutual funds. In a closed-end mutual fund, they're actually publicly traded. You buy shares in the fund instead of investing in the fund directly. The fund then goes and invests in publicly traded companies, just like a regular mutual fund. But there's an interesting byproduct of these closed-end mutual funds. Remember, their assets are all publicly traded stocks. Apple. So let's say they bought the Mag 7 stocks. They're in their assets, and you bought the fund. This should be the easiest of all companies to put a number on, right? You know the value of the 7 stocks, you add them up, that should be the value of the company. But here's the puzzle. It's called the closed-end puzzle. When you look across closed-end funds, it turns out that the typical closed-end fund trades at a discount of about 15 to 20% on the value of the companies that are in the fund. You see why I call it a puzzle, right? Because it seems like there's an easy way to make money then, right? What could you do? Buy all the shares in the closed-end fund, liquidate the fund, and get a 15% premium from selling the shares. We'll talk about why that might not be easy, but why do you think there's a discount on a closed-end fund? It should be trading at the asset value, so why do people attach a discount? Why did I attach a discount to cash in the hands of company B? Because it earned a return on capital less than the cost of capital, right? Remind me again how much the average active mutual fund beats the market by every year. It doesn't. It underperforms the market by about 1 to. So let's take this typical fund, 11. Let's say you need to make 11.5%, but they're making only 11%. So what are they doing? They're investing your money. They're making 11% on the money when in fact they should be making 11.5%. So you invest $100 in this fund, it makes $11 a year. Let's say in perpetuity. If you make $11 a year in perpetuity on a fund where you should be earning 11.5%, what's the value of this fund the instant you invest in it? What's the present value of a perpetuity? You take the $11, you divide by your rate of return that you require, which is 11.5%, you're going to come up with like $96. You've attached a 3% discount to the fund. Why? Because you expect the fund managers to invest and earn a return less than they need to make. If I make 10.5%, the discount will get bigger. You already see why discounts are going to vary across closed-end funds. Is the worse you perform as a closed-end fund manager, the bigger the discount is going to be. Because I worry that you will keep doing this. Yeah, good. The open-end funds, nothing happens, right? But your money flows into the stocks. Whatever the stocks are worth is what your fund shares are worth. It's not a publicly traded company. It's just a conduit for your money. So there, basically, if the stocks go up or down, you go up or down with them. There's no additional discount attached because I'm not buying shares in the fund. I'm just investing through the fund directly into stocks. You buy shares in the fund. So when you have $10,000, you don't send it to the fund. You just buy shares in the fund. They take that money then and invest in stocks. That's the step where the discounting happens. Okay. Yes.
Because they get to choose and they don't choose that well.
Exactly. You're building, again, it's a stupidity discount. The worse the fund, the bigger the discount is going to be. Which raises the question, why don't people then buy closed-end funds and open-end them, right? Because basically, if you do that, that discount should disappear, right? People do try. The only problem is these closed-end funds are set up in the Cayman Islands. They're set up in places where the corporate governance makes it really difficult for you to get to it. So they continue to exist. Can you have a closed-end fund that trades at a premium? What has to be true about that fund then? You expect the manager to be a really good manager. I'm going to give you my picture of the most famous closed-end fund in history. It's called the Berkshire Hathaway closed-end fund. You don't think of it as a closed-end fund, but what does Berkshire Hathaway do? It takes insurance money, it's Geico's insurance money, and it invests it in stocks. And for the bulk of its life, it's had the most famous fund manager in the world investing in stocks. It's Warren Buffett and Charlie Munger. So every insurance company has this setup, right? They take insurance premiums, they have to invest the money, but in most insurance companies, it's the very average manager or below average manager. But Berkshire Hathaway is an impressive insurance company. Geico is one of the most impressive insurance companies in the country, plus the best closed-end fund. And the way this showed up is if you looked at Berkshire Hathaway's market price, remember its assets are all publicly traded stocks, Coca-Cola, Washington Post, it traded at a significant premium on the market value. So that premium, if you look at it, 1998, 99, was immense relative to the typical insurance company. People were paying a premium for Berkshire Hathaway because it had a closed fund manager that people regarded as the best ever fund manager. But here's something that's happened over the last 20 years. The answer, I think, is obvious, but help me out anyway. That premium has pretty much disappeared. It's been disappearing for a while, but it's gone away. There is no Warren Buffett premium left in Berkshire Hathaway anymore. Why not? And so you could argue value investing must have run its course, the things that, so that's one. What else? I know it's a morbid thought, but the man is 92 years old. You know what? He turned over the actual picking of stocks 10 years ago to Todd Combs and Ted Wexler. He did it openly, it was public information. We like to preserve the illusion that Warren Buffett comes in at 92, he looks over financial statements, he computes ratios, but the man is 92 years old, cut him some slack, right? He drinks a lot of Coca-Cola, partly to keep awake, I think. But whatever it is, I mean, he is not picking stocks on a day-to-day basis or even a month-to-month basis. And much as you might read fluff pieces about Warren Buffett, the market knows it. And this year it got a reminder of mortality, right? When Charlie Munger died. So when you see premiums that are attached to a person that you think is a super manager, it lasts only as long as that person is going to last. So that's the first stop, cash. Any questions on cash cross holdings? Yes.
Oh, that premium is still there.
Well, if you compare, if you focus in, the premium is actually Geico has a premium as an insurance company, but the way to measure the premium is relative to the book value. Relative to the typical insurance company, the book value, price to book ratios have now very quickly converged on a typical insurance company. Okay. Part of it is a changing landscape. And I've talked about and I've written about value investing kind of losing its way this century because it's so focused on assets and book value. And we live in a world where neither has much meaning. But part of it is just people getting old. Let's talk about cross holdings. There are three ways you will see cross holdings accounted for. If you own 3, 4, 5% of a company and you take absolutely no role in running the company, it might be classified as a minority passive investment. What does that mean? In your income statement, under the operating income line, it's always under the operating income line, you have to show the dividends you receive, dividends, not even net income, the dividends you receive from those cross holdings. And in the balance sheet, you got to show what you originally invested to get that cross holding. I'll give you an example. SoftBank in 1997 derived 70% of its value as a company from one holding, an investment that it made in Yahoo in 1990 as a venture capitalist, or 92. But if you looked at Yahoo's income statement, all they had to show is the dividends they were receiving on the Yahoo holdings, which was what? Yeah, was paying no dividends, so there's nothing there. And on the balance sheet, they showed a value for Yahoo of 50 million, the original investment, when in fact was a $7 billion holding, completely disconnected from reality. Luckily, most cross holdings don't fall into the minority passive group. They're classified as minority active holdings. If you have minority active holdings, you have to use what's called the equity approach. What does that mean? If you own 10% of a company, you have to show the 10% of the net income or net loss, better than dividends, in your income statement, but below the operating income line. And in the balance sheet, you got to update your holding for the retained earnings. So it's like an updated book value in your balance sheet, a little better than minority. And then, of course, you get to majority holdings and accountants flip out. They make you consolidate, act like you own 100% and show that non-controlling or minority interest on the liability side of the balance sheet. So first step in assessing cross holdings is actually figure out how they're accounted for. And this has become messier with joint ventures that have entered the game, where you have some joint ventures are consolidated, some are partially consolidated. So the first step, if you have a company with a lot of cross holdings and joint ventures, is to find out what the accounting looks like. In a perfect world, though, here's what I would do to value a company with cross holdings. I'd first strip the cross holdings of companies. So many companies with cross holdings, or some companies with cross holdings, report a parent company financials and consolidated company financials. I go to the parent company, which is just the core company. I value the parent company first. And then I take each cross holding, I don't care whether it's minority or majority, and I value the underlying company with its own cash flows, growth, and risk, because they might be very different from my company. In the end, I add the numbers up. Sounds easy enough, right? But tell me the informational requirements for me to be able to do it. First, you need parent and consolidated separate statements. Not all companies do it. Second, I need full financial statements for every single subsidiary. If you can give me that, I can do it, at least in theory. Saying, what do you mean at least in theory? I'll give you a story of why cross holdings are such a mess. The late 90s, I was doing, I think, the second edition of my investment valuation book. And as part of the book, I was brought in a Japanese company, and Japanese companies in the 90s were always teetering on the edge of disaster because it was so different from every other company in the world. Risk-free rates in Japanese yen were much lower than the rest of the world. Growth rates had to be lower. So I followed the rules. I finished my valuation. I'm patting myself vigorously on the back. And then I read the financials of the company, and they mention they have 227 cross holdings. So if I'm a careful person, what should I do next? Go value 227 other companies to decide whether to invest in one company. I'm an incredibly lazy person. I'm not going there. But even if I'd chosen to go down that path, I wouldn't have been able to do so. And here's why. 167 of the 227 companies were privately owned businesses with zero information provided. 60 were public. I could have done this. But the 167, I wouldn't have been able to. So I called the investment relations officer of this Japanese company. Very nice lady. And I said, look, I'm valuing this company. It's not for an expose. I just want it for my book. I need some information in your cross holding. She said, I cannot give you that information. I said, why not? She said, it's proprietary. The way she said proprietary was actually kind of scary. And I said, what if I bought 1,000 shares of your company and then asked you? She said, still be proprietary. I said, I'd be part owner of the company, refusing to tell me what I own. She thought about it for a moment. She said, you have a point, but it's still proprietary. At this point, I'm banging my head against a wall. I say, okay, and I get ready to hang up the phone. She said, wait, I do have some valuable information I can give you. Thought maybe she's going to give me revenues from the subsidiaries, operating income. I said, what? She said, I cannot give you specifics, but they're worth a lot. I said, okay, let me get this straight. I'm entering LOT into that cell in my Excel spreadsheet. I'm getting errors all below. How many zeros are there in a lot? But this cuts to the heart of the cross-holding culture, right? What do managers do? They hold up a brown paper bag. So trust me, it's full of cash. Can I look? No, I'll count it for you and tell you exactly how much is in the bag. And we let them do it. With cross-holding companies, it's exactly, why would they ever let you look in the bag? So in the real world, the problem we face is that information is not available. But let me show you what you can do if the information is available. About 10 years ago, I valued Yahoo. What was Yahoo doing 10 years ago? This is a search engine that nobody searched on, and an email program that only people over the age of 70 used. So it's a dying business. I did an intrinsic valuation of Yahoo, and with generous assumptions, I came up with a value of about 7.4 billion. But Yahoo in 2014 was a very strange company. Its basic business was shrinking and dying, but it had two holdings that were immensely valuable. One was a 35% share of Yahoo Japan, a separate publicly traded company. And for some reason, the Japanese still seem to like Yahoo to check things out. Don't ask me why. But it's a publicly traded company. I had their financials. I value the company. 35% of Yahoo Japan's equity is 7.4 billion. So basically, it's almost that 35% is worth as much as Yahoo's operating assets. And I'm not done. There was a second holding they had, which was 21% of a very young Alibaba, just as it was going public. So the prospectus had been filed. I did an intrinsic valuation of Alibaba with what were, I thought, pretty reasonable assumptions. The value of equity that I got was 146 billion. 21% of that is 32 billion. This is a true intrinsic valuation of three companies. I add them up. I come up with the value of Yahoo as a company. If I want to bring in capital gains tax, because remember, if they sell these holdings, I can do that as well. But this I could do because all three companies, I had full financial statements. But in most companies, you don't have this kind of richness. Here, there are only two, I can do it. But here is basically the challenge you face. In most companies, you got to settle for an approximation. You won't be given the full financials. In most of the companies, all you get is the book value of these holdings. And many people use that book value as their stand-in for market value. Sometimes you can get away with it, but let's talk a little bit about that, how you could convert that book value into an estimated market value. Let's say I told you that your cross-holding is in a chemical company. The book value is 100 million, but I told you a typical chemical company trades at 1.8 times book value. And I'm my industry average. If you go to my website, I can give you the price to book ratios per sector. I'm going to take the 100 million, multiply by 1.8, and have an estimated market value. Saying that's so subjective. Guilty as charged, but if you use 100 million, you're making an assumption too, which is the price to book is 1. I'll take the 1.8 over the 1. So one thing you can try to do is convert those holdings, especially if it's, if it's on the books as book value, into estimated market values. You can do that both for your minority interest, which is from the majority holdings, as well as the minority holdings in other companies. So we live for approximations. And in fact, I took Yahoo and I did a pricing of Yahoo. What does that mean? Rather than do a full intrinsic valuation, I applied a multiple, EV to sales for all three companies to get an estimated pricing. And this is a shortcut, right? You're not getting the full financials. You get just the revenues from the three bits. I get a pricing of 5.9 billion for the Yahoo operating assets, almost 12 billion for 35% of Yahoo Japan, and about 26 billion from Alibaba that had just gone public. Am I happy with this? Not really. But in a sense, you got to live with what you have. And you can see with cross holdings, the biggest challenge is getting the information into the process. So cash, most of the time, just leave it as is. But if you have a particularly bad company with a bad history, that cash might be being discounted in the hands of the company. Cross holdings, do the best you can, again, with the information. If you have a company that is one big cross-holding and another publicly traded company, you have no choice but to value that publicly traded company to bring into your intrinsic valuation. Let's talk about other assets. Again, the key rule is you want to make sure you're counting only those assets that are not generating cash flows that give you a discounted cash flow valuation. So here are some examples. You could have an overfunded pension plan. You know how, very few US companies pay pensions anymore. But there was a time when most US companies paid pensions to their employees. And there are two ways a pension plan can be structured. One can be a defined benefit plan, and the other is a defined contribution plan. Does anybody know the difference between the two? What's the difference between a defined contribution and a defined benefit plan? And so with defined contribution plan, the company takes your money, it invests it in index funds, mutual funds, ESG funds, got to help you. And at the end, whatever you get is whatever you get. But with the defined benefit plan, I promise you $500 a month for as long as you live. When you have a defined benefit plan, you have a liability as a company, right? Those promises you've made become a liability, and you set aside assets, you have pension assets, and you might end up overfunding the plan. Why? Because you put your money into stocks, stocks went up 30%, you became overfunded. Technically, that overfunding belongs to the shareholders. And there might be people who say, we should be adding the overfunding. It could also be vacant assets, things that are not being used. So you could say the unutilized assets. So the question you're asking when you're looking at the balance sheet is what on the balance sheet is not already on? And let's face it, most of the stuff in the balance sheet is already in your cash flows. If you're adding 7 items off the balance sheet, something is wrong here. You're adding things you shouldn't be adding. So let's talk about what kinds of assets. Yeah. You've heard of the Michael Price Fund? Michael Price Fund is a fund that about 22 years ago, Michael Price he sold his mutual fund to a Japanese investor at the height of the market. He became a billionaire. And when somebody becomes a billionaire, NYU gets really interested in you. And I usually stay out of the game. So this time, you got a billionaire who said, can you go to Michael Price and ask him for money? And I said, no, I'm not doing that. It's your job. You go beg if you want to. I'm not going to be begging for you. They said, no, this is for a very specific purpose. We'd like Michael Price to fund a portfolio that MBAs can run. It still runs. It's called the Michael Price Fund. So if you're an MBA, you get picked. There are a group of 10 MBAs who get picked. They run the fund and they turn it over to the next group of MBAs. It's done reasonably well over the last 22 years. But I've never had any official connection with the fund because I'm lazy. I don't do stuff like that. I say other people carry the weight. But almost everybody who goes to the fund has taken my valuation class. And the way the fund works is you pitch a company to everybody else in the fund. And if they like your pitch, they do. So people come and try their pitches on me. So about 15 years ago, I'm sitting in my office. This MBA, I've never really liked the guy, comes into my office. And he says, he's in the Michael Price Fund. He says, I'm facing a conundrum. I very quickly swiveled to my computer, type in the word conundrum because I have no idea. Turns out he was confused. I don't know why he didn't say, but I like the word. I said, what's your conundrum? I said, my conundrum is I'm valuing Playboy. I said, I don't see a conundrum yet. He said, I've done a discounted cash flow valuation. I've come up with a value of 240 million. The stock's trading at 280 million. I said, I still don't see a conundrum. I slipped in conundrum like 5 times with the conversation. Okay. Don't buy the company. He said, here's my conundrum. I said, okay. Okay. He said, there's one asset that Playboy owns that I haven't counted. You know what he was talking about? The Playboy Mansion. It's one of the most valuable properties in LA. At that time, it was estimated to have a value of like 150 million when he walked into my office. So the question he was asking is, can I add the 150 million to the 240 million? Because that'll make it undervalued. What's your answer to that question? Is it in the cash flows already? It's maybe if you have playmates wandering to the mansion, you make, I know it's very difficult to see, but it's tough to tell that it's in the cash flows. He said, what should I do? I said, no. There's a problem though, just adding the 150 million. There's a 80-year-old in a bathrobe hanging out in the mansion that you can't throw out onto the streets. You know who I'm talking about? Hugh Hefner was still alive. He lived in the mansion. So right now it's not, you can't liquidate it. He's there. So he said, what should I do? I said, check the actuarial tables. So what am I checking for? Check to see how long 80-year-olds who surround themselves with 26-year-olds tend to live. Probably not that long. Let's say you come up with 5 years, you know what to do next, right? Then take the expected price you will get for the mansion 5 years from now, discard it, use a cost to cap for real estate if it makes you feel good, add it on. And then I forgot all about this conversation. A few years later, I opened up the Wall Street Journal and Playboy came up with this incredibly creative way of eating their cake and having it too. They sold the mansion with Hugh Hefner in it. I'm not kidding. This Greek multimillionaire bought the mansion with Hugh Hefner in it. The condition was Hugh Hefner would stay in the mansion till he died, and then this guy could move in. Think about it. So if you have any wealthy CEOs living in Florida and this huge, maybe you can sell the building with the guy in it and say when he dies. So this is the kind of vacant asset we're talking about that you can add on. So I'm going to leave you with that because when we start on Monday, I want to talk about a few more loose ends, probably cover the rest of the loose ends, but I'll see you on Monday and start working on your valuation if you can, because you know.
Yeah, I was also saying.
We talked about the discounted path or premium path, mostly based on management.
Almost entirely. Oh, you trust somebody. If they find some good opportunity for cash, great. If not, it's a huge sales cash.
So it's not just the history of current capital.
You're using that as a shortcut, right? If you have a bad history, it's very difficult to create a story where the management is great. But the history is either you have to change the management, if one reason a new CEOs come in, they give them some breathing. But if it's a CEO who's been around running the company the last 7 years and they've delivered a bad experience, it's very difficult for them to walk away from it.
So let's say if we're taking the management premium or discount, putting it onto cash, let's say a company just has a lot of cash, but they have great management.
What big revenue already? What drives your revenue growth? This is story.
Right, that's your revenue.
Growth and margins and reinvestment, because management is not the current.
So I guess my question is like, how is, since it's already in the cash flows, why is it not double counted when you have the cash? Like, why is that not?
You might get, and that's why I said, if you build into your cash flows, reinvestment, you're saying, because I have a cash balance, I can reinvest more, I can grow more. So you probably build it in, right? It's more the discounting part. It's not going to be in your cash because that's separate, right? You can take, because when you do the discounting in your cash flows, it's for future investment. Right. This is a cash balance sitting right there. So that's not avocado. But the premium part, if you've already built in the use of this cash on future, and that's why you're getting a big growth.
Yes.
And
And then another question I had might not be such a big question, but we're assuming a constant rate of return for cash firms, and if I have the cash, but they're slightly
on cash.
on cash, but they're slightly like, let's say the firm can invest in like repo option boxes and stuff like that. They're in like half a
On
percent.
liquid stuff, there's almost nothing you can do to be deceived. There's no value added from that. You're doing it for convenience. You're doing it because you have short-term cash you're rolling over. But generally speaking, you almost never see interest income on cash. Greater than the people. So you actually have an advantage over the company because your cash, more solidly from the company, because the company is an evolving cash balance. It's actually much more difficult for a company to keep up with you.
They're rolling
Because
over.
the cash is rolling over. It's, you need to take cash out, you need to put cash in. So it becomes much messier for a CFO to be managing cash than you and I to be doing exactly the same.
Got it.
I think that's one reason, if you have a sufficient cash balance, don't put in a money market fund, because then you're giving up. Anybody with at least $10,000 in cash has the option to directly buy vehicles. You don't have to worry about this $250,000 limit that you have when you go through a money market fund. This is basically directly investing in US Treasury. You go and you hit the auction, you can hit the auction button, you can tell how many units you want, and the auction clears. There's zero transactions costs, and you have your money invested in exactly what a portfolio manager with $50 billion is earning.
Right.
Right.
All right. Thank you so much.
So for those spreadsheets, my firm is losing money and probably will be losing money for a while. And I see you have that one, I think it's the FCS Ginsu that has like a bunch of, like every tool like you use. The high growth one doesn't have that many tools,
Don't use alcohol, use it.
but that one it said like, if it's negative, you have to normalize it.
The FCF, simple Ginsu, not the Ginsu itself, simple Ginsu, one that I sent you the link to, the YouTube video. I'll send it out again in case people have lost it.
So don't use that bigger one?
Don't use the high growth one, because it's a more primitive version of the FCF of simple Ginsu.
Ah, okay, but don't I want those extra tools?
Yeah, that's in simple Ginsu too.
Oh, okay.
Both the Ginsu, all Ginsu models have tools. The simple Ginsu is built around revenue growth margins and reinvestment.
Okay.
The FCF of Ginsu is built on return on capital and reinvestment rate that requires more stability. It won't work for Mondays.
Yeah. Okay, and so you're saying it's good to have a cash balance, but it's sometimes hard to get cash, particularly in the market, but Apple would never need that much cash on hand.
Yeah, it's nobody, nobody thinks Apple makes cash, but it's not hurting. When I invest in Apple, I think so when I invest $1,000 in Apple, the way I think about it is I've invested about $850 in Apple and $150 in T-bill. I actually reduce my T-bill holdings. So as an investor, to me, it makes little difference whether Apple is doing it for me or whether because I keep some of my money in cash anyway. It doesn't really hurt me then. So that's why when a company invests in cash and leaves it there and you're not worried about wastage, it doesn't matter to you. Adjust the rest of your portfolio to reflect the fact that this company is holding cash.
Okay.
I mean, that could change if I start mistrusting Tim Cook. And I think just like Google, there is this worry with Apple about where is the company going? Not so much because it makes bad investments, but because it seems to be outside of the iPhone, there seems to be really no narrative tying where is the company going. It's an iPhone upgrade to iPhone upgrade company. There seems to be the services might be the only business that's building on the side. But all of the rest seem like just vanity projects, right? What's Apple Plus doing? No idea, right? They spend incredible amounts of money producing these shows. What's the end game? Obviously, they're not competing for subscribers and making them a subscription. So with a lot of Apple's stuff that they've done on the side, there's no narrative that ties it together other than we're a company, we're a big company, we're technologically advanced. No, Apple virtual reality glasses. What exactly is that the end game here? $3,000. It's not obviously a mass market. And if you're going to sell only 1 million of these for a company with $2.5 trillion market cap, this is going to be like a drop in the bucket. So the Apple, I think it's less an issue of lack of trust, more an issue of the narrative being lost. What's the end game?
Okay. And then last quick question. You're saying the average closed-end fund or mutual fund is going to be trading like a 15-20% discount. But if you're in your example is a point, there was losing by 0.5% and it's a 3% discount.
So I just picked one. So my guess is if you took those discounts, a good research project, and then you looked at what their history was in terms of returns on their investments, I'll wager that the funds that have the worst performance relative to the market are the most discounted. The funds that perform the best relative to the market have the premiums.
But you think that it's going to be proportional? Like
I don't know whether
it has
it's
to be-
proportional. The example I gave, I made it a perpetuity. I'll tell you what drives. The faster you grow, the bigger the discount is going to be if you're a badly managed fund, because then you're destroying value at hyperspeed. So the high growth funds that invest badly will have bigger discounts than more mature closed-end funds that underperform. It's growth and underperformance together that determine the discount.
Okay. All right. Perfect. Thank you.
How are you?
I'm good. I'm Paula, by the way. I don't have a question about the class, but I don't know if you remember, but apparently my uncle was your TA in 2007. I don't know if you remember Natso the Famino. He was Spanish.
Yeah.
Do you remember him?
Yeah.
No, he's gonna be so happy. He just wanted to see if you
Say
remember.
hi to him. I
Yeah.
haven't talked to him in a long time.
Yeah,
so,
yeah.
you know.
He spoke very highly of your class, which is why I'm taking it. So
I'm
yeah,
glad,
he's back
yeah.
in Spain doing well.
So where do you live in? Madrid, Barcelona?
I'm from Madrid and he lives there, yeah, but I'm obviously studying here.
Okay.
And yeah, he's still investing, probably using your valuations, so.
Good, I'm glad.
techniques.
Tell him hi.
Yeah, well, he's gonna be very happy to remember.
I have it because I have all the classes going back to 96. I still have the 97 class on my computer, so you know.
Okay, very cool, all right, great.
Yeah. Thanks.
So I have a question on
Yeah.
the book value of that. So it is like I can I'm referring to the Amazon one and
Mm.
like check the balance sheet, but like I cannot although I'm not valuing Amazon, but like I want to make sure like the way that I add the
It's all
book value
interest
is.
bearing and lease debt. It's short
I-
term, long term.
Yeah, but I cannot like get this value.
I did that before the full balance sheet came out. I was basing it on the
Uh-huh.
earnings release that was.
But like if we refer to this one, the last 10K before,
Yeah, that's going to be because I have the actual 10K. When I
Yeah,
did
it's
this,
just
the
like
most
the-
recent 10K hadn't fully come out. It was an earnings report, so I had the, whatever they report in the earnings report, which is not the full 10K because it was 2 days after their
Oh.
earnings release.
but this one should be the same as last 10K, right?
That should be the same as last.
But like,
10K.
how can I get this value? So it is, there's no short-term debt and, this is 2022, so we add add this value. And we also need, because
Add-
there's no short-term debt, I think.
You add the long-term debt to the,
So so we need to calculate the debt value of lease.
no, that's already
Oh.
there, right? That's the long-term lease line.
So we just add this one and this one, but like it is not the value of,
No, wait,
Like
go
the
back to that
Anderson?
page.
it is,
So how much do I have as total debt?
it's, okay,
161 billion, so 162 plus 72.
it's like 15,
Did you
one.
check the?
Yeah,
the
I
other
tried
items?
different calculations, like I
Yeah.
just want to make to this value,
Yeah,
but I
just make
cannot
it
get
interest
it.
bearing debt and leases for your company.
But like for the, like, I just need to add the long-term debt and long-term lease
I use the
liabilities.
S&P Capital IQ total debt that they have for Amazon because S&P actually goes into the items and if they look like they're interest bearing debt, they move them into total debt. So I don't know where they found the other debt. I'll have to check what S&P is using as total debt. But that's the total debt that you see there is the S&P Capital IQ total debt for the company.
But like for our calculations,
Just use it off the balance sheet. Take the interest bearing debt and leases, add them up. And use them.
so just long-term lease liabilities and the
And
long-term
there'll be,
debt.
check the current liabilities. You might have short-term debt and short-term.
Yeah, but like if there's no,
Then you just take long.
okay, thank you.
Okay.